I'm Glenn Campbell. I call myself a demographic philosopher. I'm looking at life and trying to predict the future through the lens of demography, or the study of human populations. I'm trying to view humanity from a distance, like aliens would see us from space. In this episode, I want to take another stab at explaining the messed up macroeconomics of the world in the simplest possible terms. I've tried to do this before in other episodes, but it's so important that I'm going to try it again from a different angle. And this time around, I want you to imagine a world without any money. That's my rhetorical device for the day. If we lived in a world without any hard currency like dollars or yen, would the economy still be as screwed up today as it is? And the answer is yes, it could be, because there are other things that stand in for money that can be just as distorted as money can. So imagining a world without money shouldn't be too hard, because humanity has lived most of its existence without it. In a medieval village, for example, most people might not have had access to hard currency. So what did they do? Well, they bartered with each other, of course. And barter is the only truly honest monetary system. If one farmer has an excess of chickens and another farmer has an excess of beets, they can trade with each other and both parties are going to win. At least they'll get a more balanced diet that way. And you can barter virtually anything for anything, like goods for services. For example, you can work in the fields for a farmer and maybe he'll pay you one chicken for every day that you work. And if you don't happen to need a chicken, well, then you can take it to the village and trade it to someone else for something that you do need. If you're a blacksmith, you can take raw metal and add value to it by hammering it into a tool, which in turn you can trade for chicken or beets. Whether you grow a vegetable, or you raise an animal, or you form raw material into a tool, you are creating value that can be traded for other things. And I call this an honest monetary system because you always know the value of things, and the objects you are bartering are concrete and right in front of you, so they can't easily be faked. The only problem, of course, is that trading chickens and beets and tools can get really awkward, given all this merchandise you've got to carry around with you. And it would be much easier if you could trade your chickens and beets for something more compact. Let's say like little circles of metal, which you could carry in your pocket. Then you don't have to carry around all your chickens. And that's how money was born. Initially, it still would have been an honest system because the discs of metal would have had value in themselves. In the days before mass production, copper and iron would have been mined and smelted by hand and would have been quite valuable in itself, even as a small disc. So those discs of metal in your pocket could be melted down to make nails or hinges or things. And even when being used for trade, the metal itself was worth something. It had an intrinsic value that was comparable to what it was being traded for. It was just a more convenient form of storing your value than carrying around a chicken or a bushel of beets. Now, this still really isn't money, at least as we think of it today, because those discs being traded were intrinsically worth something. And there's a long history between moving from metal discs that have an intrinsic value to moving to paper currency and computer entries which have no intrinsic value at all. But we're going to skip that whole history in this episode. We are assuming, for the sake of argument, that money was never really invented. So if you have a civilized society and no money, how do you trade with others? That is, without carrying around a lot of chickens. A chicken has intrinsic value in that you can eat it, but it's hard to use as a medium of exchange, at least in its physical form. You can't stick chickens in your pocket, and they're a pain to maintain. So how do you remedy this situation? How do you make a chicken more portable? And it's actually pretty easy. Let's say you know that you're going to need a chicken a month from now. Say for some chicken soup party you're going to throw, but you don't want to house and feed the chicken for a month. You just want to assure your supply of chicken. So let's say you pay a bushel of beets to the farmer, and he gives you a piece of paper promising to give you or the bearer of that piece of paper one chicken a month from now. So now you've got a piece of paper instead of a chicken. You've traded good money, good beets for this piece of paper. And this piece of paper depends on the good word of the farmer that he'll deliver, but it's also very portable. It's very easy to take this piece of paper, put it in your pocket, or trade it to another villager for something else that you need, and that other villager turns it into the farmer. So right away, without having any government authority, we've invented a currency. We call it chicken futures or a chicken dollar bill, which is just one person's promise, one person's IOU to another person. So you don't really need a government issuing a currency, which is our standard definition of money. Any merchant or product manufacturer can issue a promise, a sort of de facto currency that can be traded just like it was money. Merchants used to do this all the time in the 20th century, issuing various forms of coupons or gift certificates that consumers could trade among themselves and eventually redeem for some product. For example, McDonald's had gift certificates that could be redeemed for hamburgers, which kids could use to trade among themselves to get the things they wanted. So even if there is no money in the world in the traditional sense, you can still have a vibrant economy just dealing in these paper promises of things. So here's a piece of paper. It can be redeemed for one chicken. Once you have this coupon in your hands, you can trade it like a dollar bill for the things you really want without having to carry the chickens around. I call this a representative economy, which is when you trade symbolic tokens that represent other things. You don't need government money because the token is the money with no government involved. And this is essentially how most of our economy works, even in the present day. What financial markets do is not trade things per se, they trade the promises of things. That's what a stock is. It's a piece of paper that says you own a certain share of the future profits of a company. It used to be that you'd physically own a piece of paper called a stock certificate, which you kept in a safe and that proved your ownership. Nowadays, we've dispensed with the paper itself, but the same underlying ownership system still holds. If you own a company's stock, you're holding a promise of future profits or future chicken that eventually is going to come your way. Formal money is just an intermediate medium to facilitate these transactions. Most investors don't hold on to their money for very long. Instead, they turn their money into promises of things. They can sell one stock, turn it into money, then buy another stock, which is a promise of future profit. Or they can buy commercial real estate, which is also a promise of future profit. And then there are bonds and other debt instruments, which are promises that someone else will pay you the face value at a certain future date. Even if you deposit money in the bank, you are exchanging cash for the promise that the bank will eventually pay you back. So most of our economy consists of promises on paper or promises in computer memory banks, but promises. And most of what our economy is not dealing with real tangible stuff. It's dealing with promises. And all of these promises don't really need a currency. A currency is certainly convenient, but it's not essential. I can trade chicken futures for beet futures without any intermediate currency involved. If a currency didn't exist, we'd just hand pieces of paper to each other. And this is probably what would happen if the US dollar or other major currencies broke down. Someone would set up an online clearinghouse where promises of chicken could be traded for promises of beets or anything else you wanted. Anyone could create a promise for anything, like future chickens, and trade it for a promise of something else. Merchants would be expected to actually deliver on their promises, or they get booted off the platform. And in fact, this could very well be where things are headed if currencies actually collapse. But before we get to that stage, we need to think about how this system could possibly go bad. What could go wrong with trading the promises of things? The problem is actually quite simple. It has happened again and again throughout human history. Whenever there's a market that's sprung up for promises, the inherent risk of any promise-based system is that people promise more than they can actually deliver. Think of the chicken farmer issuing promises of future chicken. If he finds himself in a financial bind and needs resources right away, it's going to be very tempting to him to issue more promises than he has chickens. At the least, he may use the most optimistic estimate of his future chicken production when estimating his future chickens. At the worst, he can commit fraud and make up imaginary chickens that he knows he can't deliver because he hopes to, flee the country or come up with another plan before the promises come due. Wherever a system of promises exists, overpromising is bound to creep in because the temptations are huge. This is especially true when there are big financial pressures in the present and the promises don't have to be fulfilled for many years. And that's exactly the problem with the economy today. There are far more paper promises in the world than can possibly be fulfilled. In other words, in a variety of realms, there are far more chicken futures in the world than there are chickens. And sooner or later, the people holding those futures will realize the chickens can't be delivered, and the market for these futures is going to crash. And this is going to happen all over the economy because everywhere you look, there are just too many promises. The overpromising is obvious in the stock market, which at the time I'm recording this is flying higher than ever before in spite of the pandemic. Those stocks represent a promise of future profit that in most cases will never be able to justify the current high price. It's not necessarily true that anyone has lied. Companies are required by law to be honest about their past profits. It's just that naive investors have bid up prices way too high beyond the profits that can actually be delivered. And there are all manner of other debts and assets in the world that can't possibly fulfill their promise. But the one example I keep coming back to is government debt. To talk about government debt, I should probably throw in some currency because everything ultimately gets valued in terms of dollars or euros or yen. To avoid complicating things, let's just assume there's no inflation. A dollar will always be worth a dollar, and it will always buy you, a hamburger or something. Any debt, be it a consumer loan or a government bond, is a promise to pay dollars in the future. And those paper promises are a sort of currency that can be traded between investors as though they were cash. Technically, only the Federal Reserve can issue currency, but in practice, the U.S. government does it whenever it issues a bond. A bond is purchased and traded among investors as though it was cash. When an investor buys a 10-year government bond at something like 1%, they are buying into the belief that 10 years from now, the government will pay off that debt and that inflation is not going to erode the value of it, both of which are very speculative assumptions. In fact, there's no way the U.S. government can pay off all its debts, ever. Even if there's no inflation ever again and interest rates remain close to zero forever, no pay down is ever possible because there's no way the government is ever going to balance its budget again. Things have just gone too far. Like the chicken farmer promising more chickens than he has, the government has promised more future value to bondholders than it can possibly generate. The government's chicken is called taxes. And in 2020 and probably 2021, the government is spending roughly twice as much as the taxes it is taking in. Think of it as taking in 3 trillion chickens a year, but spending 6 or 7 trillion chickens. This isn't just the result of the pandemic. In 2019, in nominally the best of times, the government was borrowing 1 out of every $4 it spent, or 1 out of every 4 chickens it's using. So even if we get back to the 2019 normalcy, the debt is still impossible to service. The government just can't pull 1 trillion chickens out of its hat. The best it can do is promise people 1 trillion chickens. They can never deliver. All around the world are people and institutions who hold this debt, who think they have a $10,000 bond that they can redeem for $10,000, but they really hold nothing but paper promises, promises of chicken that can never be delivered. So far, the government has been able to make good on its debt. Every maturing bond has been paid off so far, but that's only because the Ponzi scheme hasn't collapsed yet. And that's what this is, a Ponzi scheme. Early investors are being paid off by later ones. Like any other Ponzi scheme, there's no viable business plan behind it. There's no plan just to break even, never mind make a profit that can start paying down this debt. So investors say the government can never default because it owns the printing presses and can print as much money as it wants. And yeah, but what are we talking about here? Chickens or the promises of chickens? The government can always print more promises. What it can't do is print more chickens. The chicken inflow, meaning the actual value coming into the government, is limited to the actual number of chickens collected in taxes, which is limited to the number of chickens the economy is actually producing. I don't know what chickens consists of here in this analogy, but it's basically the core output of the economy that can be taxed. And this remains fairly constant over time. The government has an income of about $3 trillion a year, no matter how much it spends. Printing more chicken promises than the taxes can deliver encourages just a different kind of default called inflation. The risk here is that you buy a $10,000 bond right now, and 10 years from now you turn it in and you get your $10,000 back. But that $10,000 might buy only what $2,000 buys today. Maybe that $10,000 only buys you a hamburger. That's what inflation is. The fact that there's so little consumer inflation right now doesn't comfort me. You can't just keep printing money forever. Someday the dam will break and all the inflation that's been pent up will come spewing out. A representative economy, that is an economy of paper promises, is a relatively recent thing. It's been supercharged by the computer revolution, which has made the trading of promises instantaneous and very easy. Humanity just hasn't had the time to develop the wisdom they need to regulate this. You can't keep the farmers from selling more chickens than they've got. And in the case of government bonds, you've got the government selling more chickens than it's got with no hope of restraint. It's just so easy to sell paper promises. That's what every politician in the world is doing right now. Many of those politicians won't even be around when the bills come due, so there's no incentive to balance the books. No one's addressing the debt right now. They're just trying to save lives during the pandemic, which is admirable. It's just that those saved lives will be lived in a very bleak world when this whole promise system collapses. So what does it mean in a practical sense when promises collapse? It means that the perceived wealth of the world is much greater than the actual wealth. Think about how someone measures their own wealth. They're going to inventory all of their assets, all their stocks and bonds and real estate and gold. They'll see that the value of a stock is currently X dollars per share, and they look at Zillow and they see that a house in their neighborhood has recently sold for Y dollars, and they add it all up and they get a net worth of, 𝓉𝓸𝓷𝔃𝓲 million. That's what they think they're worth, but it's an illusion because it's only what you'd get if you sold everything today and the value of a dollar remained fixed. What can happen almost overnight is that the bottom falls out of an asset market. So maybe you only get half of what you expected to get, and you really only half as wealthy as you thought you were. For example, what a house sold for in your neighborhood last week doesn't mean that a year from now, your house is going to fetch that price. Your house might not be sellable at all. And that's an evaporation of wealth. And it can happen almost in an instant, as soon as people realize that the promises they're trading just aren't what they thought they were. With every oversold promise, there's a day of reckoning sooner or later. You don't know when, but it will come. Every Ponzi scheme collapses, and the world is an interlocking system of them right now, starting with that big government Ponzi scheme of selling more bonds that can possibly be paid off. In a world without money, you know the system has collapsed when you take your chicken coupon to the farmer and he can't redeem it because he's run out of chickens. In a modern economy, it might happen in a variety of ways. A formerly high-flying stock can collapse almost to zero. Inflation can eat away at the value of an asset, even if the nominal price doesn't change. Certain unique assets, like real estate, might not be sellable at all. The only thing certain when promises collapse is that the holders of those promises, the owners of the stocks, bonds, and real estate, will find that they've lost all or part of their wealth. There were just too many chicken promises and not enough chickens to pay them off.